Well, as the calendar flips over to 2019, let's make some predictions. We can do that in the area of ag economics. And when we do that, we talk to JP Gervais. He's chief economist with Farm Credit Canada. JP, how's it going?
It's going very well. Happy 2019 to you, Sean, and all the listeners.
Yeah, JP, it's interesting. There's a lot happened in 2018, and we're early days here into 2019, but it looks to be it's shaping up to be a very interesting follow-up, should we say? And you posted a post on the FCC Ag Economics blog on the Farm Credit website, and talking about some of the big things that we can see coming here in 2019. Let's run through it.
Yeah, so you're right, though. A little bit of a follow-up on 2018, right? If one word to sum up 2018, I would be thinking about maybe volatility, uncertainty, ambiguity. And if you think of all the trade tensions and how this is going to unfold and all that. And then I don't think we have put this behind us. But the one thing, I was thinking about this morning. First time we talked in 2019, and I'm like, what's the number one thing that we, 12 months from now, where we're going to say, wow, this was the one thing that, and of course, you need to elevate yourself a little bit and not just to focus on the very specific, but there's just one thing to me that you and I have mentioned in the past, and that's the strength of demand for the commodities that we sell. 2018, despite all the volatility, I think for the most part, and then you can point out pulses and you can point out a few things, that didn't go really so well, but I think we had really strong demand for the commodities that in Canada we do have a competitive advantage. And so 12 months from now when we talk again, hopefully, we say, hey, that was a year where things that matter for that robustness of the demand that we faced, they actually evolved in the right direction, which is, what is that? Well, Canadian dollar, trade agreement, the strength of the world economy, right? This is another thing on the radar that you and I have discussed in the past. There's just a number of different things like that we can discuss.
Yeah, and so when we think about demand, what do you see happening with demand for ag commodities as we probably are going to see a continued slowdown in the global economy?
Yeah, correct. And frankly, I am a little bit surprised that we haven't seen, we just had this week a Bank of Canada monetary policy report, right? So every other Bank of Canada rate announcement, we do have a report that comes along with the announcement, and then they put out their forecast of the world economy and the Canadian economy and so on. And they did not revise significantly. I think it was, if I'm not mistaken, 0.1% down when it comes to the entire world economy, which is for 2019, which is not a big deal. We had the IMF, which is sort of the worldwide authority when it comes to global forecasts. We had the IMF brought down the rate of growth in the world economy from 3.9 to 3.7. But again, not a big deal necessarily. And I'm actually a little bit surprised that we're not reading more into it. So a couple of reasons maybe why. Maybe most of the observers are not necessarily so worried about the state of negotiations and the state of the relationship between China and the U.S., because to me that's a big driver of the health of the world economy. If China is not able to solve their issue with the U.S., I would expect that economy to slow down further, and that would make it a big hit on the entire world economy. The U.S., the governor of the Federal Reserve or the president of the Federal Reserve is actually on the record saying he's not expecting a recession. I don't as well, but I do expect quite a bit of weakness leading to 2019. So all of that to me is sending a signal that, we're going to have a weaker growth in the global economy. Still going to be growing, but that's something to keep an eye on, right? Lots of commodities, supply is rising everywhere. So you need to be able to sell that supply. And that's the number one thing to me that stands out for 2019.
Well, and if there is a deal struck here between the U.S. and China, ag commodities are bound to benefit, because ag commodities are one of the first thing, of course, that the president mentions when he talks about a better relationship with China going forward, specifically about things like soybeans and pork come to mind, and of course dairy from a U.S. perspective right away. Now, earlier, though, you mentioned the Canadian dollar, and the Canadian dollar is really something that is, quite frankly, insulated Canadian farmers from some of the economic downturn that American farmers have faced in 2017 and 18. We've kind of floated between 70 and 80 the past 5 years, JP. What do you see for 2019 on the dollar? Because we have seen some recent appreciation.
Absolutely. Our forecast is at 75 cents on average for 2019. I haven't looked today, but we're just slightly above 75 lately. So to me, I'm still very confident in that forecast. I think full disclosure, though, Bloomberg is forecasting everybody that puts out a forecast on the loonie. They published a piece in terms of summarizing exactly where those forecasts are. And the question was, what do you think, the loonie is going to end at for 2019? So at the end of the year, what do you think the loonie is going to be worth? And the range of forecasts was 74 to 84 cents. So quite a wide range. Well, at 75, you could say, well, we're sort of in a lower range, a lower part of that range, but it's an average, right? So if we believe that we're going to have a little bit more weakness in the first half of 2019 and then a little bit stronger loonie in that second half, we're not that too far from that midpoint range of the forecast for which is 78 cents. So in that, between 75 and 78 throughout the year is what I would expect the loonie to be. And absolutely, if it turns out at the end of the year that we say, well, you know what, the demand that we expected to be strong and hasn't really materialized throughout 2019, I would suspect that a big part of that would be a Canadian dollar that is actually going above 80 cents. As long as it stays under 80 cents, I think I'm fairly optimistic that we're going to be okay. Tighter margins for crops, margins in the livestock sector are going to be tight, and in the hog sector may not even actually turn to on average a positive situation. We're flirting with break even for 2019 right now, looking at the futures market, especially for those smaller scale operations. So the loonie is going to help a whole lot then.
Boy, I'll tell you what, JP, even if we see some price appreciation in the commodities based on a little bit calmer waters on the trade front, an 84 cent, let's say it is an 84 cent dollar at the end of the year, that's going to negate some of those gains in profitability for farmers for sure.
Yeah, it would. It would. And the other thing also with the loonie is that it's always worked to our advantage in terms of smoothing out some of the fluctuations in the commodity prices that we've recorded in the last few years, right? So whenever commodity prices weakened, our dollar weakened as well, and that actually helped us out as ancillary, as you said, compared to the U.S., which had somewhat of a major slowdown in the farm economy going all the way back to 2014. Now, I don't see why the loonie would not move in the right, quote unquote, right direction for us, being, sort of the opposite the movement in ag commodity prices. But there could be situations in which it doesn't happen, right? So, for example, an oil market really strong, whereas supply, we don't have any type of weather disruptions in the world market when it comes to crops, and that brings a very, very large supply in the world market that weakens commodity prices simply because on a supply concern. You could see some situations in which the loonie would not move necessarily as we've seen it moved over the last 4 or 5 years. I don't expect that to be the case, but that's only a risk, right? So keep an eye on the loonie. Forget about all the different reasons why the loonie would move, and then keep an eye on the loonie, because that could be the number one factor improving or having an impact on profitability.
So are some of the people that are speculating on the upper end of that prediction range, are they expecting Canada to move forward with interest rate hikes where maybe the U.S. wouldn't? Is that really where a lot of that could be driven from?
Yeah, that's what it is. That's what it is, really. And then if you look at, but again, you just don't see it. I just don't. I mean, if you're looking at financial markets right now, and yes, in the announcement of the Bank of Canada, there was mentioned that, they're still looking to bring that overnight rate from 175 to a neutral stance, which is between 2.5 and 3.5. So another 75-point basis increase in interest rates. And I just don't see it in 2019. Actually, markets are actually not even assigning a very strong probability of one rate hike before the end of 2019. I still think there's going to be one. I personally believe that there'll be one in the second half of 2019, perhaps even a second one very, very late into 2019. But it's just, I just don't see it. So that's true. That's the upper range that forecast for the loonie would be based off, the Bank of Canada really outpacing the U.S. in terms of interest rates, and perhaps a bit of upside in the oil market.
Okay, well you've got an estimate for or a prediction, I should say, for the Canadian dollar over the course of the year. What about crude oil? Because that also is a big driver of the Canadian economy. That money flows into create demand for, obviously, food and other goods. It's a real driver for our economy. What do you see happening for oil in 2019?
It is, and the big difficulty here that I'm stuck with, and I know you're not going to feel bad for me, and I'm not asking you to do so, but it really is that spread between the Canadian and the U.S. benchmarks. We just don't have a real good, solid tool to understand that spread, and so I'm really stuck, trying to speak to what I think is speak to the U.S. benchmarks first and foremost, and then hope that, some of the discount that we've had is just behind us. We've managed to put that behind us now. Big impact, as you said, for the Canadian economy, right? So the Bank of Canada is on the record saying, up to 0.5%. They're not yet there. But I think, what I'm reading between the lines is that they perhaps say, hey, worst case scenario, we could get to 0.5% cut in GDP growth based off what a normal scenario would be, based off the recent slowdown in the oil market. That's the one market that I didn't get really right in 2018, and I'm just going to double down and say, hey, I just don't see the oil market picking up strongly, and I'm just again focusing on the U.S. benchmarks. I just don't see it picking up. It's just this loss of supply. World economy not being as strong as everybody expected. Do expect some downward revisions to the world economic growth in 2019. So to me, it sounds as if we're probably going to get a weaker demand that we expect, and I'm just not sure that we're likely to see an oil price significantly above where it stands right now. Again, focusing on the U.S. benchmark, and that drives a lot of the forecast that we have for the room, quite frankly.
Well, and the overarching thing about all of this, when we talk about the Canadian economy and what it means for Canadian agriculture, we haven't even mentioned NAFTA. And that still has to be ratified, and that we have an agreement. But without the ratification, there is still somewhat of a lingering cloud that goes with that, and it's definitely looking to be a bit of a fight on the U.S. side on this one, and that could have an impact as well in 19.
It could. I mean, I just think that at one point, the U.S. government, when I say government, I mean Congress and the president and the executive branch, they have to have a win at one point. And to me, that sounds as if, to me anyway, it seems, from far away, it seems as that something that's quite possible to get an agreement on. Yeah. Yes, perhaps Democrats want a little bit more on the labor side and so on, but I think they'll be able to get beyond that and pass this. So I really do see it implemented in 2019. For supply managed industries, it would mean some significant adjustments, especially with dairy, but depending on the date at which this is implemented, we may not actually have much of an impact in 2019. If it gets pushed to mid-2019, then you get a period of time where it's going to take a little bit of time to see any impact, and really you're going to push that into 2020. For all of the other sectors, especially the export-oriented sectors, I'm expecting this to be really a status quo in terms of the relationships, trade flows, and so on. So really, I'm feeling quite positive now. That's not my number one area of emphasis, looking at some of the potential drivers for 2019.
I'm with you. I'm on your side on that one. There's going to be some squawking. There's going to be some debate. There's going to be some threats. But the reality is, I think it gets through, and we have a ratification, and we move forward in the latter half of 19 with a new USMCA deal, or whatever we're calling it. So, hey, JP, thank you very much for joining me here today, and you have yourself a great weekend, okay?
Have a good one. Thanks so much.